presentation contains current opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello, everyone, and welcome to the Compak YouTube update for March 25th, 2024. I'm Mo Ansari, President of Compak Asset Management and the Chief Investment Officer. Thank you for joining me today. First of all, let me remind all of you, you can all subscribe to all of the communication we have from Compak, the weekly YouTube update, the weekly podcast, the Market Minute newsletter, and all of the events that we have. They're all free. You can attend by simply going to compak.com/media, and you can subscribe. Make sure to subscribe, click the subscribe button on this, so whenever I do an update, you will be notified. Let's start with the S&P 5234, new all-time highs last week in the market. We're up 2.31% for the quarter. Well, for the year, we're up nearly 10% for the S&P. The Dow also closed at 39,476, up nearly 2%, up 5.25% for the year. The Russell was up 5 at 5149. It was up 1.61, still lagging the S&P. It's only up nearly 2.5% for the year. And the NASDAQ was up 2.86% for the week, up nearly 10%, 9.63 to be exact, but not as much as the S&P. So we're seeing some rotation out of the NASDAQ into the S&P stocks, which is good overall, the broadening of the market. Communication services was the leader last week. That was the best sector, up nearly 4.8%. Real estate, the worst, down 0.4% for the week. So not a big change. We're still seeing technology and industrials also up, doing well. So we're seeing a broadening out a little bit of the market, which is good. We had the FOMC meeting last week, which was slightly dovish. They said they're not as concerned about inflation, still kept the dot plot, which is the indication of what the Fed is going to do with interest rates. And they still had three interest rates penciled in there, three interest rate cuts penciled in there for the rest of the year. Market was expecting that they might be reduced those to two. There's a lot of talk that we'll only get one cut, just like last year we were at 6 cuts. So market goes from one extreme to the other. But the market has gone up a lot. Inflation numbers are not coming down as quickly now, as I've mentioned since the beginning of the year, that we are going to see inflation this is the hard part to bring inflation down. The easy work has been done. Now it's going to be a little bit tougher until we get unemployment starting to go up, the economy starting to slow. That's when we do see the inflation numbers come down a lot more as consumption goes down, but consumption is still doing well. We saw the rates drop last week to 4.22 from 4.31 the week before. So that the Fed meeting or the Powell press conference was construed as dovish. I don't know if it was really dovish, but that was the market interpretation. Market was looking for anything to make it a positive news. I think the market has extended, as I mentioned, for the last month and a half. But you have to go with it. That's why you have the allocation that you do, so you can handle it. You don't get panicked out or pushed out of the market when we get these blips and the wiggles in the market, which we are going to continue to get. We're coming into the seasonal time frame where the market, May through September, October, is where the weakest time frame of the year. We're coming into new highs. So we could see some more volatility. Plus, we're going to get closer to the election. There'll be a lot more election hoopla, and that will cause some anxiety for investors. We did see a big change in the quantitative easing by the Bank of Japan. For the first time, they're raising interest rates, and they're curbing the yield curve controls that they had, where they were, if the yield started to go up on the long, they would start buying the long bonds and so on. And they've kept it since 2016. So this was a big change in the Japanese policy, and they ended their ultra-loose monetary policy. Looking at the economic news this week, we get home sales at consensus 6.77. We were at 6.62 million units. Durable goods comes out tomorrow morning or day after tomorrow. Expected is 1% increase. We're looking at durable Goods ex transportation is up 0.4. Initial claims come out on Thursday. That's expected to be around 212,000 number. It's GDP final quarter 3.2. That's already out in the market. But then we get the Chicago PMI on the 28th of March, expected to be 46. That's a good number, but still 50, below 50 is we're seeing contraction there, but it is expected to go up from 44 to 46. We'll see how that comes out. Personal income comes out, so not a lot of data, very big data. We have data coming out, but we'll have to wait and see. Last week we had housing starts at 10.7% increase there, and we saw the PMI at 52.5, up from 51.7, and that is good. All that is good news for the market. Let's take a look again at the technicals of the market. Looking at the technicals, we've had this great third wave rally from here all the way up to here. We've gotten above the 51.50 area, obviously trading at 52.28 this morning. That's where we are. Support is around 51.48. That is the 20-day moving average. Then we have 5,019. That's the 50-day moving average. This is the 20-day. This is the blue is the 50-day. And this is the 200-day moving average. So we should see some kind of pullback somewhere down to the fourth wave around 5,000. That's where I expect, but we'll have to wait and see when that happens. But now this is turned into a third wave. The weekly is also looking good, continue to move higher. We are still looking at that 51.50 projection. We are above that now. Targets become somewhere around 54.5 to about 5,600. That's what we're looking at here. But we could see the fourth wave down before we get to. Everything moves in 5 waves. Wave 1, up, wave 2, down, wave 3, up, which is usually the longest wave, wave 4, down, and 5 to the upside after that. So we could get into the fourth wave on the dailies and the weeklies sometime over the next few weeks, and that's going to be choppy, back and forth, pullback sort of correction. NASDAQ continues to move higher, still holding above the 20-day, which is 16,158. Then we've got 15.8, which is the 50-day moving average. Again, we came and filled this tiny gap that we had. Still looks like we are getting to a point on the fifth wave here where we had a nice rally, but we still have the weekly targets of 17,125 to 17,750. We are getting closer to that. We hit the weekly targets on the S&P. Now we'll see if we can hit the weekly targets on the NASDAQ. Do we get a correction first? Then we come down, or do we continue to move higher? We'll have to wait and see. Treasuries came down last week. They're pushing the 4.3 area down to today around 4.25. 200-day is 4.21, and that's the yield on the 10-year. Interest rates really not going anywhere now, and then we're going to get into some of the doldrums pretty soon. Oil had a big move up, got above the $80 mark, trading at 82.14 this morning. Support is at the 20-day, which is around $80, then 78.45 is the 200-day moving average. We hit the 210, 208 to 210 on the small caps, backed off from there. Now we're just sort of stuck in, maybe this is an A, B, C. That's what we get once we can make 5 waves, 1, 2, 3, or we can start a new wave count to the upside. But usually we get an ABC correction or an ABC to the downside. I think this is more like an ABC, unless, and that's what we have to watch. How do the small caps hold up compared to the S&P once we see the correction or the pullback? Those are my thoughts. Those are my views for March 25th, 2024. Don't forget to tune into the podcast where Javed and I will talk about a lot more detail on what happened last week, what to expect next week, and what to look forward in the market. Thank you for joining me today.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.